Hi all. Welcome to the Tradepedia. In this video we are going to discuss about what is engulfing candlestick. What is engulfing candlestick pattern? Engulfing candlestick patterns are comprised of two bars on a price chart. They are used to indicate a market reversal. The second candlestick will be much larger than the first, so that it completely covers or engulfs the length of the previous bar. Two types of engulfing. Bullish engulfing. Bearish engulfing. A bullish engulfing pattern is a two-candlestick reversal pattern that forms when a small red candlestick is followed the next by a large green candlestick, the body of which completely overlaps or engulfs the body of the previous candlestick. This two-candlestick pattern occurs after a downtrend. A bearish engulfing pattern is a two-candlestick reversal pattern that forms when a small green candlestick is followed the next by a large red candlestick, the body of which completely overlaps or engulfs the body of the previous candlestick. This two-candlestick pattern occurs after uptrend. Why are engulfing candles important for traders? Engulfing candles assist traders to spot reversals, indicate a strengthening trend, and assist traders with an exit signal. 1. Reversals. Spotting reversals are self-explanatory. It allows the trader to enter a trade at the best possible level and ride the trend to completion. 2. Trend continuation. Traders can look to the engulfing pattern to support the continuation of the existing trend. For example, spotting a bullish engulfing pattern during an uptrend provides more conviction that the trend will continue. 3. Exit. The pattern can also be used as a signal to exit an existing trade if the trader holds a position in the existing trend which is coming to an end. Thanks for watching. For more videos, subscribe to the Tradepedia.